Hello everyone, my name is Jeffrey Kennedy and welcome back to another episode of Market Academy. Well, today will be the fifth and final, installment of our series on how to trade the wave principle. And specifically what we're going to be doing today, we're going to be diving in how to trade a contracting triangle. So let's go ahead and get started and just kind of start off by reviewing the pattern. Remember, it is a sideways formation. There are variations to the, say, core foundational pattern, which is the contracting triangle. As you know, their variations include a running triangle, a barrier triangle, a truncated triangle, but we're just going to basically start or focus primarily on the core foundational triangle pattern, the contracting variety, because the rules and guidelines are really the guidelines I'm going to be offering on how to trade the triangle are also too applicable regardless of the specific triangle formation that takes shape, be it a running triangle, be it a barrier triangle, or be it a truncated triangle. Now remember, triangle, it's a 5-wave pattern where each wave subdivides into 3 waves, specifically a zigzag. Typically one wave is going to be complicated, meaning complex, so that's going to unfold as a double zigzag, which we will identify as WXY. And more often than not, that's going to be wave C. If it's not wave C, from my experience, I find it's wave B. And if it's not wave B, then it's going to be wave A. Okay, so let's look at the basic, guidelines I'm offering on how to actually trade a triangle. Now remember, triangles are tricky. And the reason they're tricky is because there always seems to be somewhat of a predisposition to actually want to identify the pattern complete before it actually is. So the next time you're working a triangle or you think you have a triangle, when you think wave E is complete, just give it a little bit of time, because odds favor, at least for me, because I'm always seem to be in a rush, that the triangle is not yet complete. So give it plenty of time. It is a very time-consuming pattern, and that's just, again, that's kind of like, it's one of the challenges of actually working with this specific pattern. Okay, so how do we actually trade it? Okay, well, of course, again, just as all the guidelines that I offer, regardless of whether we're trading an impulse wave, a diagonal, a zigzag, or a flat, I want to see confirming price action. Okay, I don't like to guess. And again, one of the things that I've said, I think repeatedly throughout this entire series, is just because you can count a pattern complete doesn't necessarily mean the pattern is actually complete. Price action is the only thing that can confirm an Elliott wave interpretation. For example, if we have wave E complete down here for certain, we'll know that by the subsequent advance. Okay, so just simply going A, B, C down and done for wave E, I find that somewhat ill-prudent. Okay, I just don't think that's smart, because I've seen too many instances where that just simply does not turn out to be a worthwhile strategy. Okay, so heed my warning on that. Just because, again, you can count 5 waves up and done doesn't necessarily mean you have 5 waves up and done. Look for the confirming price action, because by waiting for that confirming price action, by giving a pattern another, say, 1 to 3 trading days to complete, it will serve you well in the long term. I promise you that. Okay, so here's our triangle, ABC down and done for wave E. Okay, does this mean we jump in right now? Well, based on the confirming price action concept, the answer is no. I'm looking for a 5-wave advance above the extreme of wave D to give me a green light to begin looking for a trading opportunity. Now, again, if you're kind of like early on the boat, of course, you'll have an order already in place. And as soon as we take out wave D in 5 waves, you're already in the market. And if that is indeed the case, then here's your initial protective stop. Of course, the extreme of wave E. Okay, now this actually requires a lot of mental discipline. It takes a lot of mental discipline to wait. because we're always, fighting that fear of missing out tendency. We want to get in now. We want to get in today because if we don't get in now, if we don't get in today, we're going to miss the trade. Well, that's something that we all have to deal with as traders and analysts. And ultimately, I hope you do win the battle and overcome those feelings, because there's always going to be another trade. Don't worry about if you miss today's trade. Don't worry about it. There's going to be another trade this week. I can promise you that. So this would be, say, the core guideline on actually how to trade a triangle. Look for prices to rally above the wave D extreme and do so in 5 waves. Here's your protective stop. Okay. Now, of course, some of you are going to want to front run. And what I mean by that is you want to get in early, no matter how good your discipline is. As soon as you count 3 waves down within wave E, it's going to be like nails on a chalkboard trying not to do anything. You're going to want to get in. Okay. You have to learn to curtail and manage those emotions. But I know it's going to happen. Okay. There's some of you out there that are going to want to see this 3-wave decline for wave E, and you're going to want to jump in. Okay. If you do this, okay, that's your decision. But if you do this, do not put your protective stop at the extreme of wave C. Okay. Put it at the extreme of wave A, because on occasion, not always, sometimes wave E can actually fall below the wave C extreme, i.e. a stop running move, and then the market will reverse. I remember this specifically from about 20 years ago when I was looking at a contracting triangle in soybeans. And everything was beautiful. I mean, we were working the triangle, and I was like, okay, hey, the market's bullish against the wave C extreme. We came down below the wave C extreme for like a day, maybe 2, and then boom, it took off like a rocket ship. The market just rallied, okay? But I thought the pattern was actually negated because we had fallen below the wave C extreme. Well, that was incorrect on my part. Wave E can fall below the wave C extreme, especially in highly leveraged markets. For example, if you're working with the futures markets or if you're working with currency markets, that can and does indeed occur. So this is why I do not put or recommend putting a protective stop at the extreme of wave C of a contracting triangle. Put it at the extreme of wave A. And again, this is a very aggressive approach because what you're trying to do is time the end or the culmination of wave E. You're trying to get in early. So this is a very early trade setup technique with entry guidelines and protective stop guidelines. This technique here, again, is based on the idea of confirming price action. So it's going to require you to be patient and be disciplined. Wait for the market to confirm your assessment before you green light taking a position. Now, there is another, way to trade a triangle, and this is even going to be, it's going to take you, force you to be even more patient. And that is this approach here. Okay, so you have the triangle, A, B, C, down and done for wave E. Prices move above the extreme of wave D, and then perhaps maybe even back above the extreme of wave B. Okay, now what happens a lot of times whenever you take out this little area of, say, structural chart resistance, prices move up through that, and then that area then acts as support. So a lot of times following a triangle, and I know I've kind of made this bigger than it typically is, but prices will advance or thrust out of the triangle, move above the extreme of wave D, move above the extreme of wave B, push a little bit higher, and then come back. And that's where the market is, we're seeing a change in the function of support and resistance. So in this instance here, resistance is clearly identified as the extreme of waves B and D. So once we move through that area, then oftentimes those levels will act as support. Okay, so what you would do in this instance, look for the market to push up above both extremes, and then look for a small counter trend move, and look for those extremes to act as support. And then when prices begin turning up, you can either take out the wave B extreme for an entry, or look for prices to take out the new high for an entry. And again, here's your protective stop, if that were indeed the case. So remember, as you can see here, going through the examples, You can either be very, very early. And this goes back to the whole idea that I think I offered in the very first episode of the series, is that there is not a single best way to enter a trade. There is not a single best way to manage a trade. There is not a single best way to exit a position either. Ultimately, you're going to have to figure out what works best for you, because there are several different ways to enter a position. There are several different ways to manage a position once it's been initiated. And there are several different ways to actually exit a position. You have to figure out what works best for you and your personality and your risk profile and your account size. Again, for example, this is a very aggressive early entry technique where you're kind of getting a little bit over your ski tips because you're calling a bottom without confirming price action. But if this fits your personality style, this is how you do it, okay? And then if you're a little, say, not that risky, but want to see, you're a bit, say, middle of the road conservative, then in this instance here, we know what to do. You're looking for prices to get above the extreme of wave D. Here's your protective stop. Well, if you're from, say, the show me state, then you're even going to want additional evidence. You want to see that initial 5-wave decline out of the triangle for wave 1 of the thrust, and then you want to take advantage of that initial wave 2 pullback. And then you do something. But in each instance, again, there's a risky way to take advantage of a triangle, conservative way, and even a more conservative way. Simply adopt whatever fits your personality, risk tolerance, and again, account size. Well, that's about it for me for today and for this series. I hope you've enjoyed this. Again, a lot of information that we've discussed the last, say, 5 episodes is in my book, The Visual Guide to Elliott Wave Trading, written by Wayne Gorman and myself. And of course, you can find that on Amazon.